Yeah, so this scenario is the best scenario for stocks.
Mm.
Peace allows there to be more certainty in the future and allows me to spend more money for more growth to be unlocked. I think everybody wants us to get to this scenario where we're at. Let's hope it happens sooner than later. But knowing that not only is this would this be a benefit for just people in general, this will be also a benefit for investors.
Hey, Alex, how you doing?
Doing great. How you doing?
Doing wonderful. You ready to talk stocks and more?
Yep, it's time for episode 2 of the War Playbook.
Last week you shared some feedback and points and thoughts around if war continues. What's the angle this episode?
Yeah, so today we're going to be going with the angle of what happens if peace comes into the equation. What if we get some really positive things around de-escalation, troops moving back, trade opening up, energy costs going down, all of the positive outcomes I think a lot of us would like.
Yeah, and we've seen some of that in the last few months where it's like, okay, we're, in peace, we're in a ceasefire, but yet that hasn't been permanent. This angle, we're talking about it being legitimately positive and the straits open, those kinds of things, right?
That's right. So this one is going to be truly not permanent, but at least in the near term, actual peace. So some other things to think about. So basically a credible ceasefire.
Yeah.
None of this like the
letter of understanding.
Yeah, like an actual peace deal that goes on. The risk of conflict going down, oil prices coming down, inflation coming down along with it. And then finally, one of the things we didn't really talk about last episode, but that's a really important thing, is consumer confidence in how they feel about it. Because if we get more momentum back in the consumer, that they feel better about spending their money, that also has a positive effect from there.
Yeah. So I imagine this episode, one of the changes is it's not as volatile. Maybe there's less concern in some of the other investments that you hedged your bet with some of the things we talked about last week. Encourage anyone who's watching to check that out if you want some of that context. But this is, okay, that's behind us. And what's that impact for an investor and its impact on the market? Is that fair?
Yeah, so basically think of this situation as we're starting to remove some of the uncertainty that's in the future. Because right now we have a lot of uncertainty in the future. What if that was removed?
Yeah.
And what happens when there's less uncertainty, I can be more risky, if you will, with my money as a company. Like I'm willing to invest in my future growth if the growth is more certain. If it's not certain, I don't want to take risk because I have a chance that may not pay off. So this is really an uncertainty event transitioning to more of a certain event, which has a really big, generally a benefit to stocks.
Yeah. One of the things we talked about last week was the impact of continuing in war on inflation, resources, oil. How are we framing it for this episode? Are we saying interest rates could be on decline, which opens up new opportunities? How are you, framing this?
I think a lot of the cause of inflation right now is driven by the cost of goods being up. And with energy costs being up, that's one of the key drivers. If oil comes down, the cost of energy will come down, which should be a boon for inflation, allowing rates to either hold steady or actually pull back.
Yeah.
If energy costs continue to climb, rates may actually have to be raised to kind of offset the inflation that we're seeing there. So this is why this is a positive for the stock market if there was a peace treaty, because war is not good because it creates uncertainty. When I remove that uncertainty, it allows me to get back to the ways things were. And the American economy just is an amazing machine. It cranks. So given the opportunity, this would be a positive event if we got back to peace.
So maybe not week one, but maybe after a couple months, let's say.
Yeah, so basically you can start thinking about fewer headlines around upcoming war, more headlines around earnings, which as an investor, I want to invest in companies because of their earnings.
Yeah.
I don't want to invest because of all these crazy macro events coming out there. And granted, I always have to worry about those.
Yeah.
But if I could have one less off the table, that's a really big positive.
Yeah, and would you like to, are you thinking we walk through the same sectors and seeing the impact of potential peace and a new stability on each of those?
That's right. So today we'll be walking through the exact ones we went through last time with my updated viewpoint of us trending towards peace.
Okay, great. Well, I also encourage viewers to like and subscribe so you can see the release of the new one, or go back and check out some of our previous videos on the topic. So diving in, if you're ready, which sector you want to talk about first?
So let's start with defense.
Okay.
And again, if I'm moving towards peace, it means I'm using less military assets and my need for military assets starts to go down.
Right.
So needless to say, what was a beneficiary of going to war now comes back to more of a neutral setting, because I still need to like replenish things that we used during the war.
Right.
But in general, I don't have an active thing going on where I need military assets.
Right.
So versus episode 1, this is a sector I'm not as high on if we do move towards peace.
Yeah. So maybe it's like a demand metric.
That's right.
Okay.
Yeah, so demand kind of comes down a little bit. And so again, a lot of these companies have extremely long, multi-year, multi-billion dollar contracts. So these companies are continuing to do very well even outside of war. It's just that catalyst has been removed.
That being said, who is your pick for this scenario in the defense sector?
So I'm going to stick with RTX. Again, I really like this company because they touch multiple points across the defense industry. They're not just focused on missiles or surveillance. They play kind of across all of those. Again, this is a company that has ran a lot right now. So this would be a good watch list candidate if it was to pull back significantly, because people are like, okay, we're getting out of war. This would be one that moves up my list because their growth potential is very good. Their forward PE comes down quite a bit. So if this was one that gets dinged, in the near term, it could be kind of like a buying opportunity.
Does the defense sector companies typically have a dividend?
Yes, they do. And again, it's because they have such known cash coming in that I'm able to reward shareholders with a dividend, and it's really consistent. Again, they're literally defensive because the industry they work in, but they also can act as a defense for your portfolio because they are consistent with cash flow.
Right. And we talked about the importance of dividends or the benefit of it. In fact, we have a great dividend video. Encourage listeners to check out. All right. So that's RTX. What's the next sector?
So the next one is energy. So again, this is one that I was high on because of war. This one I'm more mixed or neutral on when we go more towards peace.
Yeah.
So again, during the war that we're in right now, we've seen the cost of oil continue to go up. The companies producing oil and energy needs in general have been able to increase prices because of this, and this has affected everyone. If pressure on oil goes down and the strait opens up and trade in general opens up, this causes energy costs to go down. These companies start making less money. Again, we need energy across everything. So this is just similar to defense. This is just a catalyst being removed that allows them to make more money.
Right. You brought up an interesting point there about pricing power. And maybe their pricing power lowers a little bit, where they have to lower their rates for energy or oil or things like that. So pieces at hand, energy sector. Who's your pick here?
So this one I'm going to be changing up a little bit. So I'm going to be moving to NRG Energy. So they have power generation along with other parts of the business. So they have traditional oil, which again, like we talked about, is a boon during the war, but they also have other electricity demand components. So they have the opportunity, as the US just needs more power, they're going to be playing and leaning into that. It's another company that has really strong cash flow as well. And something that we haven't really talked about is one of the ways that these companies also reward shareholders is through share repurchasing. So I can drive my stock price up if there's less stock available out there. I can go and buy my own stock, which increases the price from there. This is one of the companies that really kind of leans into that. So in an area where I have less room for pricing power, I need more of a growth company, and this is where NRG Energy comes into play.
Okay. Previously, for war continuing, you had Exxon.
Yes.
And so maybe specifically, what do you like to shift here?
So one of the key things to keep in mind is when oil prices will come down, and if we were in a time of peace, I think they would come down considerably.
Hmm.
You're going to see every oil related stock pull back a lot.
Mm.
Those stocks have been on a run. And I mean, these are
Yeah.
massive companies and they've been up double digits. So you could possibly see double digit slowdowns within those companies.
Mm.
Now, they're going to be fine. We
Yeah.
still use tons of oil
Yeah.
across everything. Like you've mentioned before, it kind of runs the world still. But from a valuation perspective, we will see their valuation come down.
So immediate demand drops, but you still got to fill up those reserves. The need isn't going anywhere.
That's right.
It's just a little bit less attention on them as well.
Yes. And
Yeah.
it's less of an immediate boon to their
Right.
business that we didn't see coming originally.
Right, right. Okay, so that's energy. Who do we got next?
Yeah, so next is industrial and electrical infrastructure. So this is an area where I think starts trending up if war starts to go away and we come to a time of peace. During war, I have to kind of start splitting where my focus is. Like, are we focused on infrastructure at home, or are we focused on our military events that are happening overseas?
Mm.
We have massive need for electrical infrastructure build out within the US, specifically with the data warehouses that need to be built. I think this allows all the eyes to come back to the huge need that is there around electrical infrastructure.
Who do you have here?
This one, again, one of my favorite companies I'm sticking with is Eaton.
Okay.
So again, they have a catalyst from war that would be happening because of the electrical needs that are there. But they have the additional catalyst of the AI revolution that's happening out. They are a key component to the data centers that are being built with all the
Right.
electrical distribution pieces. They just had amazing earnings recently. They pay a great dividend. They're one of my favorite stocks just in general, both during this time and outside of war.
Yeah, because they're literally the picks and shovels type of company for the AI data center build out.
Yes.
So they're helping in the war front with some of their efforts, but they're especially important as we continue in the next few years to build this out. And I'm assuming we hear about the Mag 7 and a lot of this CapEx spend. This company's benefiting from that spend.
That's right, because if I need more chips, I need somewhere to put them.
Hmm.
And that's what leads to the data centers having to be built. And the data centers need key components that Eaton is able to make in there. So
Yeah.
they're just one of my favorite ways to play just AI right now,
Yeah.
because they're a direct beneficiary from it, but their type of business is very different.
Mm.
So if I have multiple AI companies, this one kind of functions a little bit differently.
Yeah, but if we do take this path, I do encourage viewers to go back and check out your AI bottleneck layer video where you talk about multiple picks and shovel type companies for this build out. Eaton happened to be one of them, but you have a lot of other ones, whether it's the cooling, thermal management, and this is outside the high profile ones like memory and chips.
Yeah, and what you're going to start seeing is we're able to apply different frameworks to multiple different things within the stock market. AI bottlenecks is a framework of how AI isn't just a simple thing. There's multiple components to it.
Yeah.
There's multiple components to war as well.
Yeah.
And this is another example of how you can kind of think about things as an investor.
Yeah. Yeah, I can't help but to think about our guy Leo that made the news a few weeks ago with his over leveraging and being margin called. But on the positive note, he had it right about the AI build out and was crushing it. It's just the timing of some of that hurt him a little bit, but he still went from like 225 million to 10 billion, and that's
I would
even
take that.
after that loss.
Yeah.
But I bring that up because if we are moving back to a full peacetime and more energy and eyes are going full speed ahead on that build out, those same companies like Eaton or all the other ones we talked about likely going to fire back up and all pistons going.
Yes, I think you would see a massive return to high risk AI plays that have those really high multiples but really high future growth. You're going to see a big return to those.
I think South Korea would be happy.
Absolutely. Yes.
All right, so I digress. Moving on, what's the next sector?
So a nice transition from this is we're going to be talking about tech and AI here. Again, I think we kind of teased it already, or if you will, revealed that when war returns to peace, I'm able to invest again my money, which means high growth companies are going to start pulling away from the average. This is an area where if we go back to peace, tech companies are going to go up, and they might go up a lot, specifically AI companies. So a lot of those companies that people may have sold to buy into the defensive or energy companies, they're going to sell those same stocks and return that money back into the tech. So again, this channel is about long-term investing. And this is the perfect example of why, if I believe in a tech stock, I don't necessarily want to sell it just because we're entering war. If anything, I should be thinking about, is this just a temporary pullback because of the war and allows that to get a better buy point on a stock that I already believe in?
Yeah. And point taken, as we've seen that already with some of the volatility, the last thing you want to do is panic sell if you recognize that the fundamentals haven't changed. It's just they're impacted by what's going on in geopolitics or whatever. And so knowing these things, having this lens, having the understanding can help give you the strength you may need in those moments of concern to not sell.
That's right.
And you have some great videos from a couple seasons ago where we talk about having that right mental mindset. And sometimes you just need to stop looking at your stock.
That's it. And these are times when that really gets tested out.
All right. So we talk about this sector quite a bit, but full speed ahead, who's your selection here?
Yeah, I'm going back to Old Faithful, and that's NVIDIA. And I don't have to spend too much time talking about NVIDIA, but the reason why NVIDIA is my pick, when all eyes are back on AI, I'm not worried about the war, I'm worried about AI data build out. NVIDIA is the leader by far and away, and it's also lagged the general AI train.
Yeah.
It's not going to always lag, so I'd rather be a little bit early on NVIDIA for when it does have that next leg up, because I truly believe that will be coming. Because again, NVIDIA is the huge leader in the market. They kind of pay this largest company in the world tax, if you will, which kind of holds it back. Because I think people have this mental block of, how can a $5 trillion company turn into 10 trillion to double my money? Well, when they hit 1 trillion, people had a hard time figuring about 2, and then 2 to 4. I think it's a matter of time before people just truly accept that NVIDIA's business is pretty amazing from that.
Yeah, so sub $200 a share currently, or at last I checked. If there is a catalyst that makes it unfettered and people see the fundamentals in new light and it takes off, we could probably see double-digit growth even at above 200.
Oh, I think so. Yeah, because when you continue to look at a forward basis, their forward PE is floating right around 20, which is just unbelievably cheap for a company that's growing 70+% with the margins they have. So again, we talk about NVIDIA quite a bit.
Yeah.
I think this is a great scenario that would bring new life back into NVIDIA.
All right, next sector, who do you have for us?
So the next sector is consumer stocks. So if the war moves to peace, hopefully this means prices will start coming down from a consumer perspective. My bill that I'm paying at the pump and filling up my car is going to start going down. I'm going to have more money available. So my mind starts shifting from more guaranteed consumer staple companies to maybe more consumer discretionary, higher spend kind of areas. Because let's be honest, most people spend the money when it's available. It's just a matter of where it's being allocated to. So this would be a very big positive for consumer stocks, specifically consumer discretionary, or those things that are more luxury things, or things I don't really need. But if I have money available, I'm going to be able to spend on that because my consumer staples prices have gone down.
Yeah, because now you might be ready to, all right, I can get that new gas barbecue grill, or
That's right.
Upgrade my patio furniture or things like that, where nice to have, but not critical. So I'm intrigued. Who do you have here?
So this one is a hybrid company, but one that I believe has multiple things that they can win with, and this is Amazon. So my pick moves to Amazon. They have a massive online e-com business, which I think would be a boon from having more money available. You can basically buy whatever you want on there. You can probably buy a car on Amazon. I know that's being pushed as well. So they have the range of consumer staples to consumer discretionary items that are also living on Amazon. They also have the benefit of being one of the leaders within AI. AWS, they're making their chips, so they have multiple things that they can benefit from. And so I think in a lower cost environment where Amazon's margins are already low, this will help really get a big boost from consumers having more money available to spend there.
Yeah, so that triple threat of consumer, AI build out, chips and tech gives it a lot of legs.
That's right. And one thing to think about too, companies are going to be wanting to spend more in a lower uncertainty environment.
Mhm.
So Amazon is going to be a direct beneficiary of corporations spending more money with them because they're going to be spending more money on AWS. So you
Yeah.
can see there's going to be more money to spend. A lot of it's going to go to Amazon.
All right. All right. So that was tech. Who do we have next?
So the next is financials.
Oh, that's right.
So the main thing that would help the banks in general is confidence within the consumer coming up. So we talked about how that's a boon for consumer stocks. That's also a boon for financials because on one hand, it may cause rates to come down. So the bank will not be making as much money from me if I'm borrowing money from them. So that's a negative for the bank. But my willingness to borrow is going to significantly increase. So the amount of people wanting to borrow is going to go up a lot. And so they're going to have more opportunities to make money from more people, which this is why this is a big benefit for the banks, that they're going to have more people interested in spending more money because they have it available and they feel better about the economy.
I could see last time we had JP Morgan Chase. Are you keeping it or changing it?
I'm making a slight pivot
Okay.
to another massive bank. And so this is Goldman Sachs. And the reason is that Goldman Sachs has a bigger business in investment banking. So where Chase is more like if I'm a personal banker, they have a bigger business there. Goldman Sachs is making a really big money on investments. So if I'm wanting to borrow more money to make more purchases that are large, I'm going to be going to Goldman Sachs. They're a benefit for exactly what I just talked about.
Yeah, and I think I can't recall if it was OpenAI or Anthropic, but recently, a couple weeks ago, one of them decided to delay their IPO,
That's right.
given the uncertainty, instability. That could change if we enter, some peacetime. And so Goldman Sachs seems like primed for that with, companies wanting to go back to IPOing and them, being part of that.
Yeah, I think that's a great call out that these banks make a ton of money when these companies IPO. And all of the work behind the scenes to get everything launched and partnering with it. I mean, it's just something that these companies have to do, And you're right. If there's more people willing to go public, there's more money to be made.
Yeah. All right. So that's financials. What's the next sector?
So the next one is healthcare. So again, healthcare is viewed as more of like a safety net for me to move my money to. So when I'm de-risking, healthcare is going to be having a negative from that because I actually want to put more risk on. So the way to think about healthcare is, should I be considering consumer goods that are focused within healthcare, or should I be moving more to the pharmaceuticals? And that might be teasing what my pick is going to be changing to.
Well, the suspense is killing me. Who do you got?
That's what we're here for. So my pick here is Eli Lilly.
Okay.
And so they are obviously been in the news hugely for all the different drugs that they have and the obesity GLP-1s have been tracking, right? So they are more risky though than Johnson & Johnson was from the previous video. They have less consistency.
Yeah.
When I'm a drug maker, people can either copy me, they can make a better drug than me, or my drug can, lose its patent over time and people can make it generic and it causes my price to go down. Eli Lilly has been one of the leaders though, and they've been doing a lot of innovation there. I really like how they're positioned. So I want to kind of go risk back on during times of peace. And that's why Eli Lilly is my pick.
Okay. And does this sector have decent dividends or are they dividend free?
It really depends on the type of pharmaceutical that I'm investing in. So there's ones like AbbVie that have significant dividends, but in general, think of these as more hyper growth companies, kind of like the tech of healthcare, if you will.
Okay. I'm sure they were big during the days of the biotech stuff and when that exploded way back when.
That's right.
I digress. Okay, so Eli Lilly, Good call out there. What's the next sector?
So the next one I want to talk about is utilities and power. So we know that war is a negative for energy companies, like the ones that are actually the providing it. But the utility companies are still going to have demand regardless of war and everything going out. We know, like we talked about earlier, AI has insane demand for more infrastructure being built out. So a lot of these companies are getting strained right now. In the last episode, you talked about how we're starting to hear about data centers getting banned because of utility costs from there. Well, the utility companies make a ton of money when all of this power is being used. So this one actually moves more towards a positive if war ends, because again, if I stop worrying about the war and focus on building out American infrastructure, utility companies are going to win.
Right. We had a pretty decent one last time. I'm curious if you're changing it for this sector.
I am making a slight change. And the company that I'm switching to, in my opinion, is a more risk-on play. So again, during times of peace, I'm willing to go more risk-on, and this is where GE Veranova comes into play. So instead of being the utility and power company literally providing the power, these are the ones creating the power generation components that are built to make out the grid. This company has been on a really big run this year. They're up a ton. They've got really amazing markets or margins, and there's a long road ahead for them to continue to provide components, because we know that we need their components to actually provide the power in all of these data centers. They are expensive though. So I'm betting on long-term growth in the backlog that they have from all the components. So it's more of a risk-on play versus where I saw with Constellation.
All right, so that is energy. I believe travel is next, right?
That's right. And so travel and war do not mix. If I move from war to a time of peace, this is the main sector out of all the ones we've talked about that I would expect to pop off versus some of these other ones.
So travel, does that include like cruise ships and those kinds of things?
That's right. Think of the airline companies.
Okay.
Think of the cruise companies.
Yeah.
Think of vacation companies.
Right.
All of the companies that fall into that realm,
Yeah.
these are the ones that are going to be winning, because guess what? World's opening up again. The cost of me taking these vacations starts coming down. And if I'm spending less on fuel, I have more money to spend on things I don't need, like vacations. And this is what, these companies are going to win. So if we move to times of peace, you're going to see some of the most biggest swings happening within this sector.
Okay. Because I'm thinking even logistics and transportation, things like that. Who do you got here?
This one I'm sticking with Booking Holdings again.
Oh, really?
So as a caveat, this sector is really not a way that I like to invest, because like we've spoken through with this series, we saw it happen during the pandemic. The cruise lines, the airlines, they get devastated during times of uncertainty. They're just too volatile for me. So personally, I don't like investing in a lot of those different companies. But Booking Holdings is my way of winning on the idea of travel improving and not really caring which provider or which cruise line they're using.
So you don't like airlines?
I do not like airlines, specifically American and Southwest. Let's put that in.
No. Jokes aside.
Yeah.
Bookings, okay, which is kind of in my mind like a tech company anyways as well.
That's right. It's like an interesting way to play travel, though it's not directly a travel company.
Right.
So you could say I'm kind of cheating picking it. But again, it's my way of saying I don't really like any of the direct plays. I like this kind of indirect way.
That has overlap
Exactly.
elsewhere.
Exactly.
All right. What's next?
So the final one to talk through is gold. So again, gold is thought of as that safe harbor. The theme of this episode is moving away from safe harbor and into risk on mode. This is a massive negative for gold. And you saw this play out earlier this year. There was a lot of uncertainty around tariffs and war to start the year. The market was really going down. You saw silver and gold increasing in price. Ever since that event, they've been kind of coming down and they've been fluctuating ever since. That shows how volatile gold can be. And that's why I don't like to play it either, because of, again, it's kind of a handcuff to volatility. Like I'm stuck to volatility no matter how it goes. So with fear being off the market, this is going to be directly negatively impacted.
Maybe there's a portion of your portfolio where it stays in, but that wouldn't be the season to continue to invest in.
I think that's right.
Yeah.
Yeah. So from a stock pick perspective for this one, I would avoid all
Yeah.
within this. I'm not touching gold in this event because similar to travel, where you're going to see some of the biggest gains,
Right.
you're going to see some of the biggest losses, even more than energy, in my opinion, coming from gold and all of the mining companies within gold.
Yeah. And if you want to maximize your potential, you're going to want to either find the growth or find the value through dividends or whatever. And so this would offer you neither.
Right.
Okay.
There's better ways to go about doing that than this one.
That's fair. Well, that is the second episode here, talking about the impact of war. This one after war, as peace becomes the norm. Tell us about what we could look forward to next week.
Yeah, so the final episode in the war playbook is going to be what happens if war was to escalate further. Again, we don't want this, but as an investor, I need to be ready if this is the case. And we're going to be talking about what's going to be happening to these sectors and these companies if that was to happen from there.
So not a positive scenario, but something that could happen. So we want to get some insight on.
That's correct. Yeah, as an investor, and especially as a long-term investor on this channel, I want to be prepared to all these situations.
Yeah.
And again, like we've talked about, most of the time, I don't have to do anything.
Right.
But it's really good to have an explanation of why things are happening.
Right. So you can interpret and understand to help getting caught up in emotional decisions.
That's right.
All right. Well, any final thoughts about this? We're moving into, as you mentioned, a peace scenario. We're more open to higher risk, higher growth opportunities. Final thoughts?
Yeah, so this scenario is the best scenario for stocks. Peace allows there to be more certainty in the future and allows me to spend more money for more growth to be unlocked. I think everybody wants us to get to this scenario where we're at. Let's hope it happens sooner than later. But knowing that not only is this would this be a benefit for just people in general, this will be also a benefit for investors.
Alex, well, thanks for sharing this week. I encourage our viewers to like and subscribe so you know when the next one comes out. And by the way, we want to hear your feedback as well. Do you agree with Alex? Do you have better picks? Let us know your thoughts. And if you're not comfortable there, you can email Alex at alextalkstocks.com. I always enjoy that section. But we'd love to hear from you. You can sign up for a newsletter as well, where Alex shares additional thoughts, little nuggets, advice, things. So check it out. Alex, thanks for talking stocks.
We'll talk soon.
Likewise, and look forward to it. Ciao.